Welcome to Module 6B. Now we're going to get into some of the nitty-gritty of using inventory and calculating inventory. We mentioned previously first in, first out FIFO, last in, first out LIFO, average cost, and other inventory costing methods, specific ID, and the retail method, which we'll discuss. But I wanted to give you, I'm going to go over to another view, and we're going to take a look at our whiteboard and get a feel for what these numbers are all about. So if I go in and I'm going to use, well, we're going to do a couple of methods. We use FIFO as one, we use LIFO as another, we use average cost as another. So we look at that and we say, okay, I've got FIFO, LIFO. What the heck does that mean? Well, let's take a little bit of a look. If I go in and say, I buy some milk, I'm going to buy $2 a gallon. I'm going to sell it for $2 a gallon. I'm going to buy milk for $1 a gallon. So I'm going to get 10 gallons at $1 a piece. Let's get it over here. And what's that total? That's, if I do the math, hope you can too, $10. Now, if I get another 5 gallons at, let's say it's $1.50. Milk is way up. And this is our $2 retail milk. What does that come out to? Looks like I'm coming out to $7.50. Right? So what's my total gas or goods available for sale? Well, if I total this up, I'm looking at 15 units for a total of $17.50. Okay, not too tough. Now, if I sell 5 units, how many do I have left? Well, not higher mathematics yet. I've got 10 units left. My question is, what units did I sell? Well, I've got some choices. I could have sold my first in, first out. Maybe the ones I got, the 10 units I had. And by the way, I'm starting with 0 beginning inventory, so I don't have to add to that. But I'm looking at my inventory. If I sold from that batch of 10, great. I got $5 worth of inventory I sold. But if I sold from that batch of $1.50, that's $7.50 worth of inventory. Which one do I want to put there? Well, the short answer is it depends. On a FIFO basis, well, we mentioned FIFO, and we're going to take a look at it. First in, first out. First ones to go out the door, $5. On a LIFO basis, the last 5 to go out the door, $7.50. And you've got to be careful on average cost. My average cost is not $1.25. My average cost is a weighted average. I have to take my $10 and my $7.50, that's $17.50, and divide that by 15. So on my average cost, instead of $1 a piece or $1.50 a piece, I'm going to have somewhere between that. If we do the calculation, let's see, $17.50 divided by 15, I've got $1. I got another, let's see, 17.25, 15, I got another, and so somewhere $1 something. 17.50, 25, almost 1. So I get 10, that's 100, 100 by 15, it's 60 something. Let's do 65, let's do 67, 167. Now that doesn't sound right though, does it? It's got to be 117. So we are going through and calculating out of the 1750, 117. Yep, that's about right. So we got $1.17 a gallon, or 1.1666 repeating technically. So if you want to go through that and say, okay, I got 5, 8, and I've got that 5, it's at $1.17 times 5, it's $5.84. calculator, but that's okay. So it is somewhere in between. So which of these costs do I want on my balance sheet? Well, let's do a little bit of an income statement. We're going to calculate gross profit. So I've got revenue. What did I say? I'm telling you, $2 a gallon milk. By $2 a gallon milk, I sell 5 of them, I get $10. I'm sorry, $2, 5 of them, yeah, I do get $10. So I'm going to have LIFO, I'm still going to get the same amount no matter what I do. Now, what's my cost of goods sold? So if I take the $5 in FIFO, just calculate that, or I take $7.50 in LIFO, or I take $5.85 in average cost, I'm going to get a gross profit of, there we get $5 in gross profit. Here I get $2.50 in gross profit. I'm going to ask you the hard question. Which one would you rather have? So I've got $4.15 in gross profit. So my question to you is, which profit would you rather have? Would you rather have $5, $2.50, or $4.15? The short answer is it depends. And then you say, well, what do you mean? I want the maximum. I want the $5. Well, personally, I want the $2.50. And average cost, that's an interesting calculation. $4.15 is not a bad number either. But I look at that and say, you know what? Why do I want the lower gross profit? Well, for selling the same 5 gallons of milk, I pay taxes on $5 profit, on $2.50 profit, or $4.15. Well, as an entrepreneur, I want to pay taxes on the lower, the $2.50. And that makes more sense to me. I'd rather have a lower profit. On the other hand, if I had a small business and I was selling it at the end of the year, I want to show $5 of profit to show how good we are and how cool we are and how profits we make, how much profits we make. Or if I am a CEO of a major company, I want to show my stockholders how wonderful the profits are. But you can see here, based on this scenario, I have double the gross profit depending on the inventory valuation method I have chosen. So there's some significance here. There's some deeper meaning in choosing. By the way, LIFO is not allowed with the international standards. IFRS, International Financial Reporting Standards, does not allow LIFO. You can't go willy-nilly. This month I'm LIFO, next month I'm FIFO. The month after that, I'm average cost. A lot of folks will change inventory valuation methods. And you can see with periods of rising prices like here, they did rise pretty drastically. We're going through inflation now too. So when the prices rise, you make less money with LIFO. When prices fall, the inverse is true. You make less money with FIFO, but usually prices tend to rise in the long run rather than drop. So hopefully that part's clear. So let's take a look at some more deeper numbers that we don't have to calculate. So I'm going to go in, we'll go back to our slideshow and do a little deeper dive on those methodologies. So first we'll take a look at FIFO. And then we have beginning inventory here, 500 units at $100 each. We bought some inventory, 200 units at $150 per unit. And total goods available for sale, we have 700 units for a total cost of $80,000. These are all sitting on the balance sheet. They're sitting in inventory. They haven't made it to the income statement yet. But then we sold 450 units during that time. So 700 minus 450, looks like we've got 250 units left sitting in inventory. At $250 per unit, our cost of goods sold, $112.5 minus the 45 is $67.5. So FIFO assumes that the unsold inventory, we're using the cost layers here. So FIFO, first in, first out, we sell the first stuff on the list, the oldest stuff. And by the way, economic flow and physical flow do not relate. I don't know about you, but when I go shop for milk or dairy, I actually kind of reach back and grab the most latest dated stuff. Same thing for breads, right? We're going to try to get the stuff that's freshest because we don't know when we're going to use it up at home. It really doesn't matter. Walmart wants to sell you on a FIFO basis, first in, first out. The oldest stuff goes out first. Oldest stuff goes out first. Sometimes they'll hold it back on the shelf and I can't even reach it back in the cooler. So I grab what I grab. And that's what they do. They want the physical flow to be FIFO. I want my own personal purchases to be LIFO. But again, that's the physical flow, nothing to do with the economic. This is purely a math calculation. So then we jump down to LIFO. But instead of selling starting at the 500 units, we sold, what did we say we sold? We sold 250 units. But 200 of those came from this latest layer. And then we have, 450 were sold, I'm sorry. 250 was left in inventory. 450 were sold. So 250 came from this layer of the 200. And then the balance was from this layer. So all of the $100 per unit stuff that we sold all of them. And that's a pretty good trick. If they sold 250 units, we get an error in the slide. So 250 units can't be at the 200 on a LIFO basis because last time was only 200 of them to sell, and the other was 250. So we got to fix this slide. But you can see that there's only 200 here to sell. That's the cost layer. We sold 200 of those, and then we sold the remaining 250 of the top units. Oh, they did actually. Take that back. 200 at 150. Yep, we got that layer. Then I guess the hours are backwards. So they should have moved the yellow is the latest layer, 200 units at 150, and 250 units at 100. Okay, so the math is right, just the colors are wrong. But you get the idea. You can see what we sold by cost layer. So FIFO, we sell the out of the 500 first. And if we don't sell all 500, we just use the one layer. But with LIFO, we sold all these 200, and then we had another 250 that we had to draw into the other layer. So our cost of goods sold, different numbers to work with. Here, we were looking at $45,000 in cost of goods sold. Here, we're looking at $55,000 in cost of goods sold. So it's a $10,000 gross profit difference. Not quite 50% like our last one, but it's still significant. Then we take the average cost. Again, it's not a weighted average. The average is not 125 per unit, folks. The average is weighted, the 700 units, $80,000 total, and we calculated 114.286 per unit. So they did the math for us, much nicer than on the display, easy to read. So we compute the average cost, and then we just have that one layer of average cost calculated out, and we have a cost of goods sold at 51,429. And average cost has to be between LIFO and FIFO all the time. If you get one that's out of whack, I mean, last time I was calculating, I said, yeah, $1.60 something, that's more than 150, and it's way more than $1. I got to be between $1 and $1.50 in the demo I gave you, and we need to be between 100 and 150 here, which it is. It's at $114 per unit. Let's talk about retail inventory costing, because sometimes you know the costs and sometimes you don't, and you have to project. So you got to take an average percentage of calculation based on the retail price. So if we have retail inventory costing, we have units times the retail selling price. We figure out the retail is. And the inventory system is still tracking the cost and the retail selling price. We get something called a cost to retail percentage. So what percentage of our selling price are the costs? And this is actually a nice calculation to help you review how are we doing in relation to what we're selling. If we've got something that's of high value, that's no one else can produce, we've got some higher margins to play with. If, on the other hand, it's a really competitive industry, and this is what usually does happen, the price gets knocked down, we're not making as much because we have a smaller percentage to play with. So we take a look and we say, okay, I've got, what's the financial effects of inventory costing? Well, we did this before. Gross profit is different. 67.5, 57.5, 61, kind of in the middle. $10,000 difference between FIFO and LIFO can and is significant, which means if you're looking at two car dealerships, or I'm sorry, car manufacturer, you say, okay, Ford and GM, if Ford is LIFO and GM is FIFO, you're going to have a built-in variance just due to the inventory methodology. So be careful, be aware, it's stated in the footnotes what kind they use. So in periods of rising costs, we actually mentioned this, LIFO inventories can be markedly lower than under FIFO. So the cost of goods sold is higher, but the inventory valuation is lower. So one of these has a bias. Think about it. The last unit I sold, if it's LIFO, that's probably closer to the current cost of replacement. Or if the last the last unit I have in inventory is the more recent, which is FIFO, I'm going to have a more balance sheet accuracy. So my balance sheet will be true to the cost of my inventory versus the income statement. So what happens is, and you got to be aware, and as I said, if you're comparing companies in the same industry or globally, I mentioned IFRS doesn't allow LIFO, and a lot of manufacturers in the US like to use LIFO. So go figure. But we are being aware and understanding. So LIFO and FIFO balance sheet are not comparable. The app requires that firms that choose LIFO, they also have to report equivalent FIFO amounts. So you can get some comparison. And there's something called a Lifo Reserve. And that's the difference between FIFO and LIFO valuations. So you're on LIFO, you must have a Lifo Reserve. Because what happens? Let's think about the big gas tank. And let's say it goes dry. So I don't know about you, but I was around when gas was 26.9 cents a gallon. And then my dad taking me to the gas station, filling up. Yeah, gas is probably a little bit more now, but think if that 26.9 cents a gallon stuff, last in, first out, let's say there's always 1,000 gallons of gas in the tank. Now, the latest cost of gas maybe is $2.50 a gallon. So you buy $2.50 a gallon, you sell it for $3, now you're making 50 cents. If the tank goes down past that 1,000, that base that I already had at 26 or probably 23, 22, 23 cents cost at the time, I'm going to make on a $3 a gallon of gas, I'm going to make over $2.75 as opposed to 25 cents. So when you dip into your, I'll call it the Lifo Reserve, the term we use, you are going to have some really distorted profit pictures when you go dry. Let's say you use up all the gas, that 1,000 gallons goes. It's pretty significant. Can have a major impact. But that Lifo Reserve is something you want. And what's the effect on cash flow? Well, taxes drive the decision to use LIFO. You pay less taxes when times are rising. So if we're looking at Caterpillar, cost of goods sold was $1.9 billion higher. That's 1934 million than it would have been if it used LIFO. So they're saving a bunch of money. Cumulative gross profit, pre-tax, lower, the opposite tax calculation. Okay. And they have additional tax saving with the Lifo Reserve period. So it has impact. That's what we're trying to get to, and demonstrating that impact helps you understand why you need to understand and analyze financial statements, each element on the financial statements. Thank you for listening to Module 6, Part B. Now we're going to go into Part C. We look forward to seeing you soon. Thank you for taking your time. Enjoy.